Thanks for joining us on lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get you the headlines this Monday afternoon. The Nifty crosses the 10,600 mark for the first time ever. All sectoral indices trading in the green.
No such luck for Airtel and Idea Cellular after Reliance Jio becomes the first telecom operator to cut data tariff in 2018.
The back and forth on Air India's divestment continues. A parliamentary standing committee says that it should be given another 5 years before you look at divestment.
Government exempts companies admitted for insolvency from minimum alternate tax.
Voices coming up on the show today. We play out an interview with former RBI Governor Raghuram Rajan and what he makes of asset price inflation. A conversation we had earlier with Dr. Pranab Sen on the GDP data, and Kapil Kaul talks to us about yet another spanner in the works being thrown for Air India's divestment.
We start with the markets, and it's been a relatively steady and good day for the markets. Neeraj is here, as always, to give us what's leading to this strength.
So it's positive. I just want to mark, just before I get to markets, Harsha, those flashes on your screen, Prakash Industries, and not that it's a really large company or otherwise, but the stock should come up on your screen. The numbers that they've posted and the forward guidance that they've given, I think they've mentioned that their EBITDA margins will move up from 12% at the end of FY17 to 25% in Q4. And it's just symptomatic of what's happening to almost anybody in this related space, pellets, steel, etc. We've seen what's happening to Godari Power and Ispat, Prakash Industries and some of the others. And look at the volumes there. That's the giveaway. It's 10 million shares on a stock which is at 200 rupees. It's not a 5 rupee stock. It's a 200 rupee stock on which the volumes are close to 10 million shares on a single exchange alone. Just shows the kind of action that is there. But yeah, you're right. The market's by and large doing very well today. Quite an exception because the rest of the Asian bourses are not doing this. So India is kind of having a bit of a lone move on fairly decent volumes at noon or just slightly post noon. Volatility slightly up. And support coming in from a lot of unknown sectors, so I mean not performing sectors. So pharma may be led by what's happening to Sun Pharma and the belief there that the halal inspection could be happening in February. So Sun leading the charge, the others are following suit, so it's good going. Banks haven't done too badly, so the strength continues in a clutch of these banking names as well. And the broader markets are punctuated with gains to a clutch of names. So I've picked out 3 or 4. I thought Deepak Nitrite, for example, is just an example of what's happening across the specialty chemical space. That stock is up 18%, again on a very impressive set of volumes. The other one is Goa Carbon and Phillips Carbon Black, both of them. Goa Carbon, of course, had results, and that stock is locked on upper circuit. But look at what happened to Phillips Carbon Black as a result. That's up about 13.5% after about a 7-8% move that we saw in Friday's session. So good going there. And Select Real Estate, led by Sobha Developers. Again, the gains might not be as exaggerated as in the case of some of these others, but 5% for Sobha, which is usually a fairly sedate stock on the back of the Q3 dispatches or Q3 sales numbers that have come out, December sales numbers that have come out, seems to be showing that select real estate pockets too are doing well. But a lot of action at the broader end of the spectrum. 10, 12, 15% seems to be an ordinary move because of a clutch of stocks which are doing this.
All right, and the headline indices continuing to move up. Thanks, Neeraj. That's the structure of the markets. The structure of the economy, well, we got to read into that on Friday, just giving you a sense of what is coming out as the analysis from the full year first advance estimates of GDP growth. A couple of points to make. The first one being that if you look at GDP and GVA, remember there are now 2 indicators that come out. GDP, which builds in the impact of indirect taxes and subsidies, and GVA, which strips that out. So the bigger disappointment has been on the GVA front because the RBI was anticipating a 6.7% GVA growth for the full year, and the CSO is now pegging it at 6.1%. It has been rightly pointed out that perhaps once the actual numbers for Q3 and Q4 come in, you could see a slightly higher number than the 6.1 that the CSO pegs it at. But taking the numbers at face value, what's really hurting the economy? Remember, this is now the 3rd year of a slowdown on an annual basis, and farm sector continues to be one big weight at 2.1% farm sector growth in a normal monsoon year. It's a disappointing one. Other than that, you've got manufacturing also at 4.6% showing fairly weak growth. Some are linking it to the weakness in export. Others are saying that it is a general sort of demand weakness, particularly rural demand weakness, which is filtering through into manufacturing. Public administration links into government spending, and that predictably is expected to be weak, but also on a high base. A couple of other factors to point out too. And this is on the expenditure side. Government spending, as we've already said, is weak. But look at the differential from a 20.8% growth to an 8.5% growth. So you know automatically one weight that is going to play out on the headline numbers. The other important point to make is exports. At 4.5% growth, exports are flat compared to last year in a year when the global economy has been strong. So we've completely missed out on that buzz. On the flip side, because of some supply chain disruptions, perhaps we've seen imports jump up. So in some ways, we are exporting out growth. Final point to make is on the nominal numbers. Nominal GDP growth was at 9.5 based on these numbers compared to 11%. And farm sector nominal growth is just at 2.8% compared to 9. Remember, nominal growth takes into effect both the price effect and the production effect, and that 2.8% number gives you a sense of why we've been hearing so many stories about agrarian distress. We spoke to Pranab Sen, former Chief Statistician of India, about some of these issues and asked him what's hurting the economy. He started by saying that rural demand and weakness in rural demand is one key factor.
The slowdown really starts with the slackening of rural demand. You know, if you think about what happened post 2009, corporate India went into a bit of a slump, but the economy kept going because of the non-corporate sector. And a large chunk of it was essentially being driven by rural demand. And somewhere around 2012-13, rural demand started to flag, and it's continued to do so ever since. So it's now a trend, and it's something that the government really needs to look at very carefully, that here was rural demand which was growing faster than urban demand during the 2004 to 2012 period, now starting to slow down secularly over the last 5 years. And that's a serious issue.
Does that, since you started on the farm sector, sir, does that link into the MSP story, the pace of higher rise in MSP having slowed down? And then if it is partly linked to that, then you get into the debate about, what is appropriate, because you have inflation worries as well to deal with.
Well, yes, it has to do partly with the MSP story, but it also has to do with what's happening globally, because globally agricultural commodity prices softened quite sharply, and India is sensitive to that. So there are lots of bits and pieces that go into this weakening story. But that's only one part of it. The other part of it is that, remember, rural India is not just about agriculture. Agriculture is at its heart, but there's a lot more to it. In fact, now more than 55% of rural incomes really comes from non-agricultural activities. So one has to really look at the rural economy holistically, rather than looking at it essentially as a reflection of agriculture.
Point taken there, sir. But on the on farm sector, just one other question I had. So, if you look at the nominal numbers in this time's release, so they're expecting nominal growth at 2.8% for the farm sector compared to 9%. That, in effect, explains the kind of chatter around agrarian distress, because you have the price effect and you have the production effect together taken. Tells you why the farm sector is hurting, sir.
Yes, it is. And that's exactly correct. And this has now been happening, actually, if you really look at this period I'm talking about, which is post 2012-13, is that farm prices have been seriously depressed. So the terms of trade are moving against agriculture, which means that even though we've had fairly poor agriculture because of droughts and because of demonetization, the price effect simply adds to those woes. And that's something quite serious.
Dr. Sen, just spinning this forward now, a lot of talk obviously about what you do to correct weakness in growth. And I have two questions in this regard. One is that, there was a recent Fitch report which talked about potential GDP growth of India being at about 6.7%. They're not the first to do it. I think there was an RBI paper a few months back which had also pegged potential growth between 6.7 to 6.9, if I have my numbers right. So compared to potential, are we really underperforming that much?
Well, a lot of these potential growth numbers are a little backward looking. These numbers are essentially emanating from an investment rate which is hanging around 28%. But remember, we've been in a situation where the investment rate has gone up to 38%. So if you really think about what we were talking about prior to 2009, we are talking about a potential growth rate for India upwards of 7.5%. Now, the belief that we cannot go back to that, I think, is completely misplaced. We can go back to that, and we really have to ask ourselves the question that what is it that has happened between then and now for the analysts to lower their estimate of potential growth rate. I mean, remember, potential growth rate is done through statistical devices rather than a structural understanding of the economy.
Is it investment, sir, then the contribution of investment to the economy? And if so, then is that the lever that, say, the budget or other policies should be tackling?
Well, this is a question that I think economists have a hard time answering. Do investments lead the economy, or do investments follow other trends? My sense is you cannot boost investment by itself. It really needs to see the economy, particularly the demand side of the economy, growing, and investments will come on their own. And then it becomes a virtuous cycle. But I don't think you can try and kickstart investment except through public expenditure, which the government is already doing.
That's Dr. Pranab Sen talking about the economy and the numbers. Let's talk about the telecom sector now. The telecom tariff war is far from over. Reliance Jio's new tariff plan gives users the option of paying 50 rupees less for the existing amount of data, or get 50% more at the same price. And when the newest entrant cuts rates, other telecom operators usually follow suit. But how do these players shape up against Reliance Jio right now, and who charges the least for data? Samit is here with some of those answers. Samit.
So I'll start off with the plans which have a validity of 28 days. Now, Jio plans which offer validity of 28 days are available at two different price points, that is 149, 198. Then there's Airtel and Idea which are offering a 199 plan. Airtel and Vodafone offering a 349 rupees plan. Then Idea separately has two other plans of 309 and 357. Now the data offered in these plans differ depending on the prices, but the cheapest plans are offered by Reliance Jio. Now the effective cost per GB for the 149 rupees plans is at 5.3 rupees per GB, which is at a discount of at least 15%. And the effective cost of data per GB at 198 plan is 4.7 rupees per GB, which is at a discount of at least 24%. Now for higher validity plans, if you see, Jio plans are available at different price points ranging from 498 to 349, and the validity and the data offered differs depending on the prices. Competitors like Airtel, Idea and Vodafone also have plans, different plans, and they have tried to match Jio on validity and data GB, data that is per GB data available per day with Jio. But when it comes to cost, they could not. Here also Jio is offering data at a very cheaper plan. Now if you see for competitors in the next plate that is there, the cost per GB ranges from 5.5 to 6.5. While for Jio, if you see in the earlier plate, the cost ranges from 3.6 to 5. In fact, Jio's costliest plan, which offers data at rupees 5 per GB, is also lower than the cheapest plan that is offered by the competitors, which charges around 5.5 rupees per GB. So this clearly shows the stark difference that is there in the data prices charged by the competitors and Jio.
All right, Samit, thanks so much for that. That's Jio's latest plan and how it compares to some of the others in the market. Let's switch focus. The Parliamentary Standing Committee on Transport is not in favour of privatising Air India just yet. The 31-member panel, headed by Trinamool Congress leader Derek O'Brien, has recommended that the national carrier be given at least another 5 years to post a turnaround. The report comes at a time when the government has already invited bids to sell parts of the airline. Joining us now on the phone line is veteran analyst for the aviation space, Kapil Kaul. Kapil, thanks so much for joining us. What should we make of this? Should we pay any heed? Will the government pay any heed to these suggestions in your mind?
Well, to be frank with you, I was not expecting the parliamentary panel to recommend the sale. So, given the composition of the standing committee, the recommendation for 5 years, because I don't know what the logic of 5 years is, but I'm sure they would have had inputs to come to that conclusion. But frankly, as I said, like the recommendation they had given earlier, it's not a binding recommendation. It's an observation and for the government to consider. My sense is that the government is fast-tracking investment, and at this stage, the Ministry of Civil Aviation. So our sense is that by the end of 2018, the divestment process.
Okay, Kapil, I'm going to hang up at the moment because I think we've got you on a really bad line. Let's try and reconnect back to you. But I'm just taking you through some of the highlights of what the parliamentary panel report actually said. It has said, and this is a standing committee on transport, tourism and culture, it says Air India has shown improvement in various parameters after a state-funded bailout and is showing indication of, and I quote, coming out of the red. Air India should be given at least 5 years to revive and its debt written off. Profit-making units like Air India Air Transport Services, Air India should not be sold. The panel essentially is saying that you should not break this down into units and sell it off. And it's likely to tell the Indian government that this is not the right time to be divesting a stake in the state-run flag carrier. This, of course, is a report from the PTI. We have to wait and watch how long, whether these recommendations are taken on board. Let's get Kapil back. Kapil, if you can hear me. So what's the way forward? We've been speaking about Air India for, I don't know, maybe 10, 15 years now. What's the way forward, you would think?
Well, Harsha, this is a very, very complex sale. It's not going to be easy because there's going to be a significant write-off. And the write-off which could be done by sale of assets, other assets that Air India has. So it's a very, very difficult task. But I think if there is any government which can pull this through, is this government. And I think if the Prime Minister has made up his mind to sell Air India, I would think that the government will follow it to its logical conclusion. But as I said, it's a very complex sale. It's not going to be easy. But if the government is very keen, I think, and they can align the offer in line with the investors, I would think that there is a significant value in Air India if it is privatized now.
Kapil, there is some sort of marginal truth in one of the assertions made by the committee, and that is that operational freedom has never been available to Air India. They've always been called in on various fronts, etc. Should we give them a little bit of that? That yes, there is truth in that. Although then I don't know if it remains within the government fold whether you can ever hope for operational freedom.
Well, I think as long as there is government ownership and they're responsible to Parliament, I don't see that changing. So it's not a realistic thing to expect that in the next 5 years they will be given operational freedom. So I don't accept that at all. And secondly, commenting on the turnaround plan, I don't think the turnaround plan is relevant at all because I think the Air India needs a new turnaround plan, and that turnaround plan which was made long back is no longer relevant as the dynamics of the market has changed. Another observation I can just add that if we wait for another 3-5 years, there may be no value left in Air India. So government will have to keep pumping in taxpayers' money, which can be used for some other social purposes. So I think if there is a time for Air India to divestment, it's now, and government may keep the airline alive and yet realize some value, which is good for the interest of the economy and the sector.
Hypothetically speaking, who would be interested in buying or investing in Air India, Kapil? Would it be existing players, external players?
So it depends upon what the offer is, because one doesn't really know what the government is intending to do and what the final offer would be. But if I assume that the working capital debts would be taken off from the balance sheet, then there would be a significant interest. You would find almost everybody interested in Air India, as long as the working capital debts are taken care of. There are other must-dos for Air India, frankly. If we go, the balance sheet cleanup is critical. You need to divest 100% of the airline rather than do piecemeal. You should allow foreign airlines to participate, because if you restrict it to Indian carriers, then I don't think the sale will happen. There should be flexibility on staff and brand, staffing and brand. If you are inflexible with respect to staffing and brand, then I think that could have an impact. There are talks that the domestic and international will be separated. I think they need to offer one integrated network. So I think the due diligence reasonable timeline should be allowed for the tender process for people to do a thorough due diligence. And I have, we have mentioned to the government they must refrain from sweetening the deal with a bilateral freeze, that because you're selling Air India and you will give them a bilateral freeze for a few years. And as long as there are comprehensive disclosures, you have a task force which continues to improve Air India till the divestment process is on. I would think that we may finally get a good suitor for Air India. The government may will stop funding and using the taxpayers' money for other purposes, and there'll be still value left on the table for the government. So, but if we delay it for the reasons that have been mentioned by the Parliamentary Standing Committee, I don't think there'll be anything left in Air India.
Kapil, we'll leave it there. Thank you so much indeed for joining us. That's Kapil Kaul talking about the aviation space and Air India and what can be done with it.
All right, let's move on. In a move to facilitate speedy resolution of stressed accounts, the government has exempted companies facing insolvency proceedings from the minimum alternate tax. Payaswini Upadhyay is with us with more details. Payaswini, much awaited relief?
Yes, much awaited relief, and if you would remember, we had sort of discussed this in November last year, that many companies were making a case for this exemption. So essentially what happens is that, any resolution plan for a stressed company requires banks to take a haircut on the interest and write down of their loans. Now this write down or this haircut is seen as an income to the company on which there is, a MAT applicability of 20%. So let's take a hypothetical example. If say there is a 100 rupee debt and the haircut and the haircut or the loan write down amount comes to 50 rupees, the 50 rupees that is this write down will be seen as the gain to the company on which there will be a tax liability. What this was essentially converting into is bidders pricing in this liability, the future liability that will fall on this incoming investor, and probably lowering down their bids, and which is why lenders and even the companies are making a case that the right value of the assets will not be captured because these bidders are accounting for this future tax liability that will fall on them. So which means now that, since that liability goes, you will get a probably better bids or higher bids for these stressed assets.
Payaswini, thank you for that. Well, coming up next, former RBI Governor Raghuram Rajan bats for steady removal of monetary accommodation rather than a sudden shock to the markets. An exclusive interview on the other side.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Welcome back. You're watching Power Lunch. Let's dip back into the headlines at the half hour. Former RBI Governor Raghuram Rajan says global growth is fueling asset price inflation, advises central banks to tread carefully but continue normalizing interest rates and monetary policy.
Fresh record highs on Dalal Street as the Nifty trades above 10,600 for the first time. Mid-cap index also hits a new high and outperforms yet again.
Airtel and Idea cellular slip after Reliance Jio becomes the first telecom operator to cut data tariff in 2018.
Former RBI Governor Raghuram Rajan says global growth is fueling asset price inflation and the rise will continue till interest rates head higher. So the only way to avoid a sudden bust is for central banks to stick to slow and steady interest rate hikes. Listen to this exclusive conversation.
Whenever there is asset price inflation, you have to ask why it is that way. And clearly there are some supports for it. Growth is strong for the first time across the world. You're seeing Europe come back very strongly in the last few quarters. Japan is going the normal way it goes, a country with a labor force declining at 1% a year. For it to grow at 1.5% is great. And the US is doing reasonably well. So with all the engines firing on the real side, there is some optimism. The concerns have to do with two factors. One is the monetary side and second, the financial side. On the monetary side, when do we see inflation? If in fact you have strong growth, you have economies at levels of unemployment which haven't been seen for a long, long time, when do we see more wage inflation? When do we see that translate more into goods inflation? That's the question on the monetary side. When that happens, you will find interest rates picking up more strongly, and of course that will have an effect on asset prices. The other factor is the financial side. How much debt have we built up in these years, in these go-go years, on the retail side, on the government side, on the corporate side? Covenant-light loans are at an all-time high at this point. So the question is, at that point, when interest rates start picking up, when liquidity seems a little less available than it is now, do we see a substantial reaction on the financial side?
Well, that's the question. When does this stop becoming just a talking point among academics on Twitter and become something that policymakers need to address?
Well, the question is, what do you do to address it? And I think the best thing that can be done at this point is a steady removal of monetary accommodation as the economies look strong. Let's not try pushing it to the last limit. I think as you remove monetary accommodation, you signal also that the financial side needs to adapt, and you give them time to adapt, which is important. So the buildup of leverage that you see, both the implicit leverage in positions as well as the explicit leverage in debt, I think that will start tapering off if in fact there is a signal that accommodation will be taken off. Now, you have to do it in a steady way because you could affect asset prices considerably if it comes as a shock.
But you don't think the argument that we can let rates stay where they are because we're not seeing any inflation is worthwhile?
Well, I think central banks obviously are forward-looking. They have to ask, is this going to stay the way it has been, going forward? And the one thing that is changing is earlier you had slack somewhere in the world. Today, with unemployment coming down across the world, the sense has to be that there's less slack. And as a result, the competitive pressures across the world, which kept wage growth down, may not show up as much going forward. So wage growth will possibly pick up. You already see inflation in some countries, Canada, for example, picking up more strongly. The second aspect of this is really central banks are also at the back of their mind thinking about financial sector risk. That it's not the front of mind is inflation, but if financial sector risk is also building up, we should not surprise the world suddenly with an inflation report which shows we are way behind the curve. So I think that would suggest, so long as there's this uncertainty, steady, slow removal of accommodation makes sense.
Well, you talk about debt and you talk about these risks. A lot of people talk about emerging markets and say there is a concern here that they will not be able to withstand a sudden removal of cash if things go pear-shaped in the advanced economies. Is that a major concern? Are we looking at a 97 or a tequila crisis kind of situation?
Well, they are, many of them, in a much better position than they were even 4 or 5 years ago. They have reformed. Some of them have focused on inflation targeting, got inflation down. So to that extent, they are in a better position. That doesn't mean they're immune. There's a huge amount of capital which has flown towards the emerging markets. And I've seen some studies which suggest a substantial portion of it is as a result of easy monetary policy in the advanced countries, which pushes capital that side. So as policy reverses, there could be some reversal. The hope is, both with stronger growth there as well as better policies, they're in a better position to withstand the reversal. So I think tequila crisis, etc., are situations where governments were relatively unprepared. I think they're in a better position, not immune.
Now, with the debt concerns you've talked about and the idea that we are seeing synchronized global growth picking up, do we need debt-fueled stimulus, as in the U.S. tax plan?
I don't think we do. I think some of the analysis of the tax plan suggests we will get stronger growth next year. But you have to ask, with the levels of unemployment where they are, what you really need is a redistribution of that growth towards the jobs that people need and aren't able to fill right now, because the jobs that are available are not the jobs that suit their skills. So there has to be a certain amount of redistribution. Some of that happens naturally with stronger growth. But the question you have to ask yourself is, with this level of unemployment, is there more space in the labor market as we get stronger growth? And if we don't, what will happen is you get stronger growth from the fiscal side, but you get the Fed having to move faster and offsetting that from the monetary side. Now, we have to wait and see what happens, but clearly that is a danger looking forward.
From your experience as the governor of the Central Bank of India, is the Fed the central banker to the world?
I think the Fed sets the tempo across the world. There is no market that is immune to the dollar, that is sort of independent of the dollar. The dollar has an enormous effect, and the Fed, of course, influences the dollar. So I think, many of our graduate students at this conference are presenting papers showing how dependent countries are on the exchange rate vis-a-vis the dollar, which is, of course, determined to some extent by Fed actions. So we are in a very integrated world. I think the Fed has been very measured as it exits, but very clear about where it's going.
And you're speaking here at the AEA on banking, and you're going to make a kind of unique argument these days that maybe people are being too tough on banks?
Well, I think we needed to get tougher during the financial crisis and after that. But I do think regulation tends to be, follow the cycle. In bad times, it gets excessively tough. In good times, it gets excessively weak. And I think we've put a lot of regulations on the banks, and it is about time that we, look at them and decide, is it enough? And is it spread well enough across the system? There are specifics which result from banking theory that I want to talk about today. But really, broadly, the question is, how much is enough? And I would prefer a level playing field across the financial sector. Don't overregulate one side and leave the other side relatively underregulated, because all the risks then transfer over to the underregulated side. I think we may be in some danger of doing that.
Well, last question. You've sat in the big chair at a central bank. You've looked at banking regulations now, and you're looking at the overall global economy. Any advice for Jay Powell as he takes over the Fed?
I can't give any advice. I mean, I think he has a tremendous amount of experience in various facets of policy making. And, it's an interesting world, and I'm sure the Fed will continue its sound activity.
Former Governor Raghuram Rajan there. Well, let's quick check on how the markets are faring today back home. The momentum seems to continue. Pradeep is taking a look at some of those stocks. Pradeep.
So first of all, on index, traders feel that because we have gone up 3 straight days, so although you are in a breakout kind of a scenario where we've taken the previous highs, therefore you expect market to keep moving one way. But if you look at the trend since morning, it's kind of going sideways, finding some resistance at higher level, which is probably normal, and traders are not really worried about it, but maybe aggressive traders have booked some profit and they are looking to come back. If you look at it, VIX has also gone up a bit, which again indicates that around current levels maybe there is some resistance. Now, the trade is more sector specific or theme specific. So we have some positive news on pharma. So it's not only Sun Pharma which is moving up. It's even the likes of Wockhardt which have done well. So a sector play is definitely going strong. There is some profit booking in metals because commodities after a sharp run up are now kind of going down. So that theme has played out. The new interesting theme which is picking up is probably the private sector banks, because several private sector banks that were kind of ignored for a long time, take for example Yes Bank or Federal Bank, or you have an RBL, all these banks, now what we say is that there is some kind of buying interest coming in over the last 2-3 sessions, and there are talks that probably not only that the overhang that market had, because some of the larger private sector banks reported large NPAs unexpectedly. This time around, maybe these larger private sector banks may show significant improvement on the asset quality front, and therefore you get a higher beta if you buy an RBL rather than buying an Axis or any of the larger banks. So that is the trade that people are really concentrating on. Telecom is another sector which is not doing so well today. But net, I think some amount of churning, some amount of sector rotation, but market remains bullish. But yeah, the aggressive traders are kind of playing it safe. Those who are trading Nifty and Bank Nifty, there could be a profit taking in next, in the second half of the day or tomorrow or day after, before we start moving ahead of 10,600 decisively.
Thanks so much for that, Pradeep. That's the equity markets, and at the headline level, they continue to set new record highs. If you check in on the currency and the bond markets, the currency markets are swaying in the direction of the equity markets. The bond markets remain slightly nervous. At 63.40, the rupee has calmed off from its early morning highs, but it had hit a 32-month high of 63.37 against the dollar in trade on Friday. The bond markets, remember today is the first day of full trading for the new benchmark bond. That, though, is the old benchmark, which is trading at about 7.31. The new benchmark was issued at 7.17 and is now trading about 7.10. There is, of course, continued divergence between the mood of the equity and the currency markets on one hand and the bond markets on the other hand. Interesting comment coming in from Sanjeev Prasad of Kotak Institutional Equities in a report that he released today. And let's put that up on the screen. Sanjeev Prasad talks about the fact that he struggles to understand the divergent reactions of India's currency, bond and equity markets to the sharp deterioration in India's macroeconomic position over the past 3 months. He goes on to say the bond market seems to be rightly worried about the downturn in India's macroeconomic conditions, but the currency and the equity market appear to be fairly nonchalant about the same. Finally says that he sees this as conscious uncoupling of various markets in India.
That's Sanjeev Prasad for you. Let's move on. Ajay Srivastava Dimensions Corporate Finance remains positive on the Indian markets in 2018. He's placing his bets on private banks and select financials this year and continues to be bullish on liquor companies. Listen in to the slice of this conversation that we had with him earlier today.
No, I don't think we should be ready for a blip at all, because let's be honest, we are looking at an interest rate scenario which is going to move north. We all know that when the interest rates move north, the banks gain a lot. Banking sector hasn't done too much in the last just couple of months. I think it should come to the table. The private banks should come back to the table again. You saw the huge fundraising coming through for HDFC Bank. You saw the, some of the stocks like Yes and Indus and etc. had a little bit of a correction. So they should come back to it. So I think there is no need to call a top. What I was saying was that at this point of time, you need to put an element of carefulness into your portfolio, because in a run-up of this kind, when things start to move up and sharply, at least in the mid-cap space, there is no place to hide if even a smallest correction comes. And the cuts can be painful. Even the last 1 year, Neeraj, you'll see when the cuts came, they've been very painful on the mid-cap and the small-cap sector. So what I said was, find stories which have still a way to run, rather than chase stories which have run their course. Of course, at any point of time, you may still get an increase in the share price in an environment like this, but that's not how you build stable portfolios. Build stable portfolios building long-term stories which can withstand the vicissitudes of the market, and market can move either way. All I said was, now we need to focus a lot more. We have a global construct which is so positive, is incredible, absolutely. we have got a policy framework which I think will be stable in India, because given the political compulsions, you can't go wrong in this market. So it's a situation where if you chase the wrong stories, you may end up, the third fact which I call is ruining the fact of being invested in the wrong stocks while seeing a market run up. That's the worst nightmare of an investor, to see his portfolio not performing in a market which is roaring and going ahead. So I think that's the challenge today this year, is that are you in the right stocks which are seeing the market upside, or you stay in a medium to a lower end stocks where you find market going up but your portfolio is not doing as well.
No, I think that's a fabulous point by Ajay Srivastava. Now, there's so much to choose from, Ajay, in terms of questioning you, since we are short of time. I will pick up from a space that you mentioned to Pradeep a while back, the liquor companies. Do you think this could be the year of liquor companies? We've already seen them move up, but if I just look at the raw material cost, and if GM Brewery's numbers are to be believed, there is a margin tailwind that could come into almost all of these companies.
Of course. This is, why this year, last year was equally good in my view. And I think, although there is a clamor in Karnataka now, they're saying that let's ban, beef and liquor perhaps. But I think what the country has realized now, that this is a revenue source which we cannot do without. And I think with the Supreme Court now clarifying its whole stance on the prohibition, I think you have a clear path to profitability in this company, and the numbers are going to expand. And the reason I think is that a lot of the uncertainties in the system are gone away. Policy framework is going to be, as I said, stable. You don't see any hiccups in these companies having a clear run on the market. And beauty of the thing is no more licenses, so you can't get competition coming in. Market is already consolidated in the right players. Of course, GM Breweries is in a different category. It's a little more country liquor oriented, or IMFL, if I'm not wrong. It's more country liquor. Fantastic. It has always had fantastic margin, but a very volatile share price. That is the problem with GM Breweries, nothing else. But I think as a sector, it's a safe, sound, viable sector where you can hold it and keep it as a portfolio. But let me be honest to you, this sector can frustrate you for days and weeks at end. You saw it this year in 2017. There were almost a couple of months the stock would not move. United Breweries did not move. Spirits did not move. But when the spirits moved, it moved the spirits totally.
All right, let's move on to another segment. This is finance and various aspects of finance. Delinquencies for India's commercial vehicle loans will remain stable, but loans against properties could see some stress building up in 2018. That's according to the latest report from rating agencies Moody's and ICRA. The report goes on to add that microfinance industry is back on the road to recovery. Housing loans will remain stable. Shraddha Babla with more details on the takeaways from that report. Shraddha.
Well, yes, so Moody's and ICRA have, they believe that India's structured finance market in 2018 will actually see a varied performance. So first, they've started off by speaking about a sector that they believe will actually see a deterioration in 2018. So for asset securities, which are backed by loans against properties, to SMEs specifically, they believe that the delinquency rates will only increase in 2018, mainly on account of the stress that has been faced by SMEs on account of GST. When it comes to the auto asset-backed securities, which are backed specifically by commercial vehicle loans, they believe that will remain stable on the back of a healthy domestic economic growth. So they expect delinquency rates to remain at about 5.4%. That is for loans on new vehicles, and delinquency rates at 6.8%. That is for loans on used vehicles. But when it comes to microfinance, they seem pretty positive, given that the collection ratios have improved from about 87% that was seen in December 2016 post demonetization to about 94% levels as of September. In fact, they've said that several microfinance institutions have reported over 98% collection ratios for the loans that have been originated in calendar year 2017. Hence, they expect fresh slippages to be arrested, and NPA levels, they say, have peaked out. So they expect NPA levels to fall in calendar year 2018. And not surprisingly, when it comes to housing loans, they expect that will continue to be seen as the best performing retail loan asset class in India in 2018. But again, the two different variations that they see as far as the asset quality is concerned, they expect asset quality to remain stable in the traditional housing finance segment, whereas they believe that delinquencies could rise further in the affordable housing segment in 2018. So that's the brief outlook from the report, which could have implications for some of the NBFCs.
Shraddha, thank you for that. SR Ports just completed a 2,800 crore expansion at its Vizag and Salaya ports. The Mumbai headquartered infrastructure player is hoping that additional handling capacity will add up to 30% to its total revenue in the next financial year. Purva Chitnis spoke to the company's MD and CEO Rajiv Agarwal to find out if the company has any other capacity expansion on the anvil.
Well, this investment is in line with the overall strategy of improving the infrastructure in some of the key locations in the country. So, we feel that, the ports are a very essential enabler for growth in any country, and our Prime Minister is also highly focused on port-led development. So we had embarked upon this plan to put up a coal terminal in Salaya, which is in Saurashtra, where we do not have any other deep water port. So this was undertaken about 4 to 5 years back, but then it has taken a long time because port projects do take time. And finally, we have been able to complete this first phase of the project, which is the terminal that we have just commissioned, which will help the region to import and export raw materials and dry bulk cargoes in a most efficient manner. As you know that India's logistics cost is extremely high as compared to other developed nations. So it is required that we keep upgrading our infrastructure, improving our capabilities to handle cargoes at a much cheaper and efficient manner. So what it does is basically that it helps import in larger parcels the raw materials, and also it connects directly to the stack yards. So it reduces the overall cost of operations or the cost for the customer. So that's the advantage. Again, if you look at Vizag, Vizag is an existing terminal which was not fully you can say operating at idle capacity because it is an old terminal, so it needed modernization. So we did that, and today we have been able to increase the capacity overall, and that will help it to grow from maybe 7-8 million tons of cargo handling to, or maybe even less, to about 24 million tons in capacity. So all in all, I think it is in line with overall thinking of the government to improve the port infrastructure.
So what is the current capacity, and like with these two projects also coming in, how will you scale up the capacity to, and what will it be?
So the current capacity goes up to about 90 million tons. And thereafter, we are planning to take it to 110 million tons by the end of next year.
So that is FY18 or 19?
So FY18, it will be 90 million tons. Okay. And in FY18, it will be 90 million tons, and FY19, it will be 110 million tons.
And how much revenue booster will it add to you?
So this will add, you can say this year we are increasing our revenue by about 35%. And next year again we will have a growth of 35% in revenue as well as cargo handled.
And the total investment on these two projects is 2,300 crore. So how will you fund this investment?
It's about 2,900 crores, which we have invested 30% equity and 70% debt.
And post this, what will be the debt to EBITDA ratio?
So it will be 1:1. Debt equity is 1:1, and EBITDA is going to be in the next year, which will be first year of full operations, would be 1,300 crores, and debt will be about 4,000 crores. So 2.5:1.
Sure. And after this exercise, can we expect more capex to come in? And if yes, then where are we expecting to invest more?
Well, we are looking at expanding in current locations like Hazira and in Salaya. And we are also looking at investing in Mozambique. So total investment that we look forward is about $500 million in the next 2 to 3 years.
All right, SR Ports, an unlisted firm, so you have to take the management's numbers for what they're worth. Let's move on. If you were one of the million addicted virtual farmers playing Farmville, waking up in the middle of the night to harvest your tomatoes, well, here's your chance to do it in real life. A Bangalore-based startup, Farmizen, allows customers to rent a portion of land to grow their own crops via an application. Bloomberg Quint's Nishant Sharma visited one of these farms to see how it actually works. Take a look.
Well, in 2009, a virtual farm gaming startup, Farmvilla, took internet by storm, more specifically Facebook, where millions of people went online to have their own virtual farms. And they were sowing seeds, taking care of the farm, and harvesting virtual fruits and vegetables. But what if I tell you, you can do all that in real time, on a real farm, and can harvest real fruits and vegetables? So we are in one of your farms. Tell us about what is Farmizen and what is this real-time Farmvilla that you're doing?
The idea is very simple. As a consumer, today we are not able to get safe, traceable food, right? So because of that, a lot of us have started growing our own food in balconies and terrace gardens, etc., right? But there are two problems that we usually face. The two problems are, one is of space, right? If you have a small balcony, we can't grow enough food ourselves. The second problem is that of time, right? Because even if I have space, I live in a big house, it will take a lot of effort for me to actually go ahead and take the continuous care that is required to grow my own food, right? So those two problems are what we wanted to necessarily solve. So the way we do it is very simple, right? Consumers have an app, right? And using that app, they book a mini farm. A mini farm is 600 square feet in size, right? And you as a consumer, you use the app to control what you want to plant in each of them, right? For example, this consumer has said, let me put palak here, let me put cabbage there, let me put brinjals there, let me put tomatoes there, and so on and so forth. So when you do all of these things, farmers actually go ahead and plant those on the ground, right? So all of the actions you are taking on the app are actually getting implemented on the field. And that's how it's different from the virtual farm bill. You can come and harvest your own produce yourself whenever the produce is ready, and you can know it through the app as well, right? So you get updates like your tomatoes are now flowering, your brinjals are ready to harvest, etc. But if you can't come and harvest your own produce, we'll anyway home deliver it to you every week.
And what's in it for farmers? I mean, why do they want to partner with you?
See, India's farmers are in a lot of distress, right? When consumers subscribe for this service, they are paying every month, right? So farmers' cash flows are taken care of, right? They don't have to wait for 3 months to get their first money. There is no price risk because some prices will go up, some prices will go down because they are growing so many different crops together, and because consumers are paying a fixed fee every month. Now in this model, because you're growing so many things together, because you're doing it naturally, because you are creating like small micro environments everywhere, so end of the day, your farm productivity itself start improving. So who gains the most from that? It's the farmer, his land, right? His soil becomes much better.
And you mentioned today is one of such days where the harvest is going to be delivered.
That's correct.
How about I'm getting on one of your delivery trucks and visiting one of the families?
Sounds good. Sounds good. That will be exciting. I think we have 32 deliveries planned today, so I am sure you won't want to spend time doing all of those 32 deliveries, but
I can surely try one or two.
Absolutely, absolutely.
The harvest of the day is all loaded into this truck. I'm going to hop into this and get it delivered at the customer's doorstep.
So we prefer this Farmizen, where we can grow 12 type of vegetable, right from dal, vegetable, fruit. We buy organic only. So we wanted to grow more vegetables in our garden, but there is very little space. Best part of Farmizen is whenever we want, we can go, we can harvest ourselves vegetables, and we can educate others, people and children, everybody about organic and how it is good for our health as well as for the environment.
Interesting story on the farmers, and let's shift focus now to the world of entertainment. Oprah Winfrey's powerful speech at the 75th Golden Globe Awards is dominating headlines today. The first major Hollywood award ceremony was marked by celebrities wearing black in solidarity of the Time's Up movement, which pays for legal defense for victims of sexual harassment at their workplace. Oprah condemned brutally powerful men for breaking the cultural fabric of society and hoped that we move towards a society where no one has to say Me too again, end of quote. Out of time on the show. Thank you so much for joining us today.
Have a good afternoon. Countdown is up next.